Now, for a closer look at today's Fed rate decision and outlook for the U.S. economy, we're joined by John Herrmann, rate strategist with Mitsubishi UFJ Securities U.S. So, John,
yes,
a bit of a mixed tone from the Fed. On the one hand, they're lowering the global outlook for the growth outlook for the U.S. for the year. On the other hand, they're keeping rates as they are, but then they're continuing the tapering by $10 billion. So what do you make of this mixed message?
Well, I think it may not be so mixed. Every time I seem to come on your show, we've had a really good day in the stock market, and the market continues to move up higher and make new records and that kind of thing. And I think we're in a very similar situation. So the Fed, as you said, the Fed did tone down its expectations for this year, but they kept the forecast for the next 2 years at their high levels. So they're optimistic. And then the second thing is they guided that they expect to, when they do remove policy accommodation and start to raise rates, they're suggesting that they're going to raise it at a more gradual pace. That also helped equities.
That wasn't a big surprise, though. We never expected a rate jump to go from anything less than a quarter of a basis point.
Very, very true. But I think the key thing is where Janet Yellen, I think, to me, surprised us a little bit, where she said that in the event that the economy starts improving faster than they think, and our forecasts suggest they will, that she said that they would begin to, normalize rates a little bit swifter, but at the same token, they don't really expect to overshoot, and they tone down their view of the terminal rate. So in the future, just how far they'll raise.
John, I'm having a problem reconciling these data points. On the one hand, the Fed is saying the unemployment picture is looking better. We're at 6%, now 5% was the rate that the Fed is really looking for.
Correct.
On the other hand, we had a negative quarter, a revised GDP last quarter, -1%. The Fed revising GDP for 2014 to between 2.1 to 2.3%.
Significant down.
But yet we're carrying on with the tapering. So how does this equal good economy?
I think where I'm seeing the improvement is, I'll just go through the bullet points. So the unemployment rate this year, we finished the last year around 6.7, and we should decline this year to about 5.8. The following year, we should decline to about, I think, 4.8, 4.9, which is remarkable. That's the first thing. Last year, we ran payrolls 192,000. This year, we're tracking 203, and there's a chance we actually track 215,000. So the payroll data is looking better. The GDP, as you mentioned, we had a soft first quarter. We had weather. We had a lot of weird things going on. So it adversely affected the entire year. But next year, we're not expecting those kind of things.
One of the big issues is inflation with regards to the interest rates. We're below the Fed target of 2%.
Right.
We have inflation hawks saying, watch out for asset bubbles and watch out for inflation creeping up on you when you're not noticing.
Right. I think that if there's anything where, the Fed is moving their unemployment objective closer to our forecast, so we feel confident. They're also keeping GDP elevated for the out years. That's more in fitting with our and the market's outlook. But I think if they're offsides on anything, is they're still too dovish in their outlook on inflation, because inflation, I think this year will get up to 2%. We will reach their target within 3 months, and then we should finish the year, almost most of the second year, at that 2% threshold, and then through, I think, all of next year. So I think they're going to be surprised how rapidly the inflation moves up to their objective.
And how detrimental is that going to be then?
Well, I think the way I look at it is, on the one hand, for businesses, having good profit growth it's helpful to have inflation, to have revenue growth. So it helps businesses. And the fact that we're starting from such low rates, 0 to 25 basis points, starting from such a low threshold versus the previous tightening cycles, we started much higher than this. I think that also helps businesses.
Well, the major consensus amongst analysts and forecasters is that we'll have 1% by the end of 2015. Agree? Disagree?
I think that's very reasonable. The Fed, although their numbers point there, actually the market, the Fed funds futures market, is not quite there yet. We're actually, the market is actually a little bit more dovish in pricing than the Fed's guidance. But I think that's where people are going to be wrong, because I think it's going to move faster.
If we see the market start to show some weakness again, what kind of action do you expect from the Fed? Any action at all, or to reduce the tapering?
Well, I think if something like that were to happen, they could slow the pace of tapering. But I think the key is the worst quarter of the year is behind us already. Second quarter will be better, about 2.5% to 3%. Third quarter looks over 3%. Fourth quarter looks around 3% or slightly better. So the best news, the best growth is in front of us.
Okay.
Which is fantastic.
That's a very positive outlook. Let's hope you're right. Thank you so much, John Herrmann, rate strategist with Mitsubishi UFJ Securities.